Ladies and gentlemen, good day and welcome to the Credo Brands Marketing Limited Q4 FY'24 earnings conference call. This conference may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kamal Kushalani. Thank you, and over to you, sir.
Thank you, Mike. Good afternoon, good evening, everyone. I have with me Mr. Rasik Mittal, our Chief Financial Officer, and SGA, our Investor Relations Advisors. I hope you all received the investor's deck. If not, you can view them on the stock exchange or the company website. I'll first give you a little brief of what we have done over the last 5 years. This I'm doing in the interest of those who were not on the earlier call, so that you just get a little brief history or what background on what we did over the last 5 years or some changes that we made. So in 2019, we conducted an internal assessment and put our learnings to reinvent the brand philosophy. As part of this brand reinvention, we developed a new brand identity designed to elevate our language across all consumer touchpoints. B, a new merchandise architecture for increasing our share of the consumer's wallets by providing them designs suited for specific occasions in our consumers' lives, multiple occasions, so to say, ranging from relaxed holiday casuals, authentic daily casuals, to urban casuals, party wear, athleisure, etc. Our focus is on creating elegant and expressive clothing for the contemporary Indian man who wants something more stylish than what is commonly available. C, a new and elevated retail identity, all tying in together to communicate the elevated new avatar of Brand Mufti. Since we made the above changes, the brand has gained in value with the consumer, and the same is reflected in the performance of the company. We have committed ourselves firmly to the path of becoming an accessible destination for the contemporary Indian man as enablers to help him express his sense of style and be noticed for his elegance and creativity. We remain committed to expanding our reach through responding to the trend of premiumization that we now see all around us. Our design team is constantly focusing on expanding our product range to meet a varied range of consumer needs. Our diverse products range now comes under the mid-premium to premium price range of clothing in India. Our products are available through a pan-India multi-channel distribution network that we have built over the years, comprising of our EBOs, exclusive brand outlets, LFS, which is large format stores, and multi-brand outlets, which is MBOs, as well as other online channels. Our multi-channel presence is planned strategically in a manner that our products across categories are available at consumers' preferred shopping channels. As of 31st March 2024, we are present in 599 cities, having over 1,800 retail touchpoints. We have presence through 425 EBOs, 77 large format stores, and 1,332 plus MBOs. During the year, we have added 52 EBO stores, and we plan to add another 30 to 40 new stores in FY'25. Our EBOs are located nationwide across 237 cities in high streets, malls, airports, and residential market areas. We also have an online presence which is rapidly growing, wherein our customers can shop through our website as well as through various e-commerce marketplaces. EBOs are central to our growth strategy, with them offering a holistic in-store brand experience and help enhancing brand visibility. Over the last 4 years, the average revenue per store has increased by a CAGR of approximately 19%, which shows the pull for our brand and products. Now coming to the quarter and the year gone by, in FY'24, the apparel market in India moderated and after an expansion during FY'23. However, at Mufti, the revenues grew by 14% to rupees 567 crores with gross margins remaining stable at 57.5% for FY'24. Revenues for for FY'24 have remained flat year on year to rupees 133 crores with gross margins at 55.9%. In a subdued market, gross profit margins remain stable despite the challenges faced in the current market scenario. This underscores the resilience and appeal of the brand amidst challenging market conditions. The market for premium and mid-premium branded apparel continued to experience softened demand due to consumer behavior influenced by an inflationary environment that curtailed discretionary expenditures while concurrently witnessing a surge in consumer spends towards travel and other essential purchases. Furthermore, the onset of peak winter was delayed across India, leading to a shorter fresh period, and that had a notable impact on winter season sales for premium and mid-premium brands during Q4 FY'24. This led to excess return stock from channel partners on account of sluggish demand during the quarter. Under Ind AS, the company has to provide for expected goods return. So in Q4 FY'23, this provision was at 14.4% of sales, whereas in Q4 FY'24, it has been voluntarily taken at 25% instead of 14.4%, considering the increased returns due to the current market scenario. This has led to an excess provision of approximately 21 crores, which has approximate rupees 11.8 crore impact on gross profit, EBITDA and PBT, and an impact of rupees 9 crores on PAT. During the quarter and year gone by, there have been an increase in certain expenses. There has been an increase in advertisement expenses related to brand building and store openings, and these upfront investments will strengthen the brand in the coming years. Also, there are increased manpower costs associated with the opening of a larger warehouse in Bangalore and sales staff at MBOs to meet growth objectives. During the quarter gone by, there has been higher return freight costs on account of excess return stock. This stock was returned to make room for fresh season stock at all retail locations in the new season, as we have always managed to liquidate leftover stock profitably. To enhance the brand awareness and strengthen brand recall, we intend to continue using targeted marketing campaigns through digital and social media billboards, multiplex cinemas, and live events. We have developed a strong brand identity through effective brand advertising and multiple marketing campaigns for our brand, and shall continue doing so. We have already in the past few seasons released our ad films across cinemas in the country, which has had a very favorable response on the brand, and it has improved the brand value with our customers. Going forward, we are investing in digital marketing to communicate even more widely the brand in its new avatar. Going ahead, we will spend on around 5% of revenues on branding and advertising. We plan to expand our store network in existing cities and new cities. We have identified several markets as having potential for opening further EBOs. This offers the potential for market share gains, increased brand recognition, and economies of scale. We are also looking to capitalize on the increasing e-commerce demand in the Indian retail and grow our share of sales from our own website and e-commerce partners. We want to leverage technology to improve supply chain management and enhance customer experience. We intend to further invest in IT infrastructure to improve productivity and increase operating efficiency and customize buying experiences of our customers both in store as well as online. To summarize, going ahead for FY'25, the company aspires to achieve mid-teens revenue growth backed by new store openings in new and existing geographies and subject to recovery in the overall industry demand for premium and mid-premium brands. The company is also targeting to improve profitability through implementation of various cost efficiency measures. With this brief, I'd like to hand over the call to our CFO, Mr. Rasik Mittal, for the update on the financial performance. Thank you, everyone.
Thank you, Kamal. Good afternoon, everyone. First, I will give you a financial highlight for Q4 FY'24. Revenue for Q4 FY'24 remained flat year-on-year at 133 crores. Our SSSG for the quarter stood at 3.9% year-on-year. Gross profit also remained flat at 74.4 crores with a GP margin of 55.9% for the quarter. EBITDA for the quarter stood at 30.9 crores as compared to 40.6 crores in Q4 of FY'23. Our EBITDA margin stood at 23.2%. This is mainly due to increased cost as mentioned earlier. Profit after tax for the quarter stood at 7.1 crore. Coming to the FY'24 performance, revenue for the full year FY'24 grew by 14% year-on-year to rupees 567 crores. Our SSSG for the year stood at 0.6% year-on-year. Gross profit stood at 326 crores, a growth of 14% year-on-year with a GP margin of 57.5%. Our EBITDA stood at 160.5 crores, a slight degrowth of 2% year-on-year. Our EBITDA margin stood at 28.3%. Profit after tax stood at 59.2 crores. Our working capital days have increased to 166 days as on 31st March 2024. This is on account of two reasons. One, increased inventory due to higher goods return. Second is, this year's sales for fresh season goods to our customers had a delayed start in Feb, for which payments are due in 60 to 70 days, and therefore it is showing an increased debtors as of 31st March 2024. As of today, we have received majority of these payments. Going ahead, we want to reduce our inventory days. We have always managed to sell our goods, unsold inventory at a profit, and never had material write-offs on account of inventory in the past. We will continue to manage this going ahead too. We are confident in our capability to handle short-term fluctuations and achieve sustainable and consistent growth in the future. ROCE and ROE stood at 19.3% and 19% respectively. The Board of Directors have recommended a final dividend of 0.5 rupees, 50 paisa per share on face value of rupees 2 each of the company. With this, we will now open the floor for question and answer. Thank you.
Thank you. We will now begin the question and answer session. Participants on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the first question from the line of Kunal Shah from Anova Capital. Please go ahead.
Yes. Why have you seen increase in provisions done during the quarter from 14% to 25%?
So Kunal, Kunal, you're audible. Hi, Rasik here. So Kunal, see, last 3 seasons, the market has been subdued, and due to that, the return of goods from our customers has been higher. So looking at the market condition, present market condition, we will increase the expected return provision for the current year.
See, I'll just add to this, Kunal. See, in the last year, the provision was taken at 14.4%. That was the first year we moved to Ind AS, where these provisions have to be made. Looking at history of the last, 5-7 years, the auditors came to advise us to take a provision of 14.4%, and it was taken accordingly. However, in Q1, on which we went public, the provision was already at 22% for Q1. Now, between Q1 and today, as we saw what is happening, to give a more realistic picture of the business, it's better to have factored it at 25%. Otherwise, if we factor it at 22 and later on the goods return is 25, then this quarter appears to be better, and the other quarter, which was actually whatever it is, may turn out to look better or worse. So to come to a more closer reality. That's where I mentioned earlier in my part that this has been voluntarily done by us, and we've spoken to the auditors and they agreed to this, and that's why we've taken the provision at 25%.
Okay. And also I want to ask, can you provide some guidance on revenues and EBITDA for the next couple of years?
And the way the scenario is looking right now, we for the coming year, what we intend to do is we intend to do mid-teens growth. However, by doing that, we have consistently been opening around 50 odd stores every year. But however, for this current year, we are not going to put a gun on our head to open 50 stores. What we're going to, aim and strive for is same store growth. We may open 30, 40 stores or fewer stores than 50 this year, but same store growth is what we'll strive for, and we'll work on efficiency of our costs to bring our profitably up. Because in our company, we have always grown and calibrating our growth through the profitability lens, and we shall continue to do that.
Okay. Thanks. That's all.
Thank you. We have the next question from the line of Naitik from NV Alpha. Please go ahead.
Hi, sir. My first question is, what sort of degrowth have we seen in our MBO channel for the quarter?
Which channel?
MBO channel, MBO, multi-brand channel.
So MBO channel for the year has degrown by around 2%.
And for the quarter?
Quarter would be around, actually quarter I have not seen separately, but we can get back to you for the quarter number.
Okay. And if you could just...
This is due to higher provision mainly.
Okay, it's not...
It's not actually degrowth because we have voluntarily gone for a higher provision for GR, which is impacting the Q4 number. That is why it seems as a degrowth. Yeah, it appears to be a degrowth in this channel.
Okay, got it. And the second question, if you could just repeat what you mentioned about the receivables, because I missed that. That would be really helpful.
So receivables, basically what happens is, after the autumn-winter season gets over, we send out goods for spring-summer to our counters and our customers. So now, this year, the end of season for autumn-winter continued till Jan. And for the fresh season goods, we were sent out somewhere in Feb. So the payments for that from our distributors and all, the payment terms are 60 to 70 days. So till 31st March, the payments were not due. That's why it is showing higher, the receivable days. But however, post that, we've received all the money. As of now, all the monies due have come to us.
And last year, what had happened is that we had, in that season, tried to push in the summer merchandise earlier and picked up the autumn-winter goods earlier to see what's the response to that. However, we saw that it's beneficial to continue with the sale and go along with the market, and we supplied the goods in Feb onwards this year, and last year it was Jan onwards, and because payments are 60 to 70 days, whatever was supplied Jan onwards was already collected within March, and this time that has been collected by now, as Rasik mentioned.
Okay, got it. That's it from my side. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question on the line of Rahul Dhruv from Pegasus Growth. Please.
Yeah, hi, good afternoon. I was not a part of the IPO and started looking at the stock recently. So if for people like us, if you could give a little bit of color on what really happened in the period FY'21 to 23. I saw the roadmap that you put on the presentation. But what I'm basically talking more about is that if you look at your EBO, revenue per EBO, it basically almost doubled between FY'21 and 23. And I wanted to understand, and that's the same even for LFO, the same for multi-brand outlets. So I'm just trying to understand what was the reason for this revenue per store going up so fast in the previous 2 years.
May I know your name, please?
Rahul Dhruv.
Rahul, hi. Rahul, this is Kamal here. So, Rahul, as I mentioned earlier, that there are a lot of changes that we did in the brand. See, once we completed 20 years in the business, we did a kind of soul-searching exercise internally, and we did, some kind of internal searching to reinvent our brand philosophy to figure what is it that we truly exist for. We've always been a profitable company. Now, do we just exist as an apparel business to make money, or does this brand truly have the potential to, become a legacy and live beyond generations? So we did that kind of study, and we realized that there are some things we need to change, because in the relevance of the landscape of retail brands since we launched and what it is today has changed dramatically. So we found our groove and our position as to where we should be, in that brand. You'll find that in the presentation on, if you could tell me what page, I don't know. So you can see in the grid of brands where we stand as a brand and what we are. So you could see, it's on page number 19, you can see that we found ourselves in a sweet spot right in between the, denim-led and casual-led brands. These are the two directions or universes that brands broadly belong to in the casual wear segment. And this is on the x-axis. On the y-axis, you see, how brands come down from luxury to premium plus, premium, mid-premium, and value brands, etc. So in that, we straddle both universes of denim as well as casual successfully, because the brand has always been a brand that has been created on its own uniqueness, has grown on its own uniqueness, and has never ever aped to be like any other brand. We are one of the brands that has a very, very strong, balanced offering in terms of bottom wear and top wear, and that is visible in our sales, which is almost half and half, and that was also reflected in the industry report. So that gives us that opportunity to cater to, multiple occasions in a customer's life. And because we are strong in both top wear and bottom wear, also get a larger share of the consumer's wardrobe. Looking at these things and the price points that we have, that where the brand stands, we are the enabler brand that as consumers' aspirations grow, as they are growing, they want to buy, consume brands that they couldn't when they couldn't afford them. So we are the enabler brand between the mid-premium, premium to the international brands. That's where we found a spot for our brand. So those are big changes that we made in our brand identity, our merchandise architecture, as well as our retail identity. And all of these changes very, very favorably were accepted by consumers, by trade and all of that. And that's what you can see has happened. And there onward, there was a price rise also that happened in the market, in fact, in 2023, which was also well accepted by the consumer. But somehow after that, it's been very coincidental. It's happened around the time when we have gotten listed, that brands in the mid-premium to premium category in particular have faced headwinds.
Right. So do you see these headwinds kind of receding? Do you see any major changes in the trends as to how, can we really see a recovery from here? Because I'm just looking at the online sales also. It has kind of gone up very sharply this year as a percentage of sales from 5 to 11, which basically I would have thought would be a function of returns or excess production, which you're not being able to sell.
So it is on account of excess returns. You're bang on there. And of course, there is also a push towards e-commerce. And that is the channel that we use to, liquidate we call it OSM, the old season merchandise. And we managed to do that profitably. Unfortunately, the last couple of seasons have been muted. And currently the scenario still, continues to be volatile, Rahul. So we are the kind of people who typically would, like to deliver whatever we say. Hence, we have moderated our growth ambitions, but we certainly want to improve our profitability and our working capital days, etc., by the end of this year. So we are aiming to do that more than trying to, grow. April was a very good month, so to say, as compared to last year, but May somehow again has dwindled. So, it's very difficult to say right now I immediately see recovery, this and that, but there's a lot of work on in the back end to ensure that we meet the goals that we have set out for ourselves.
Okay. If I may ask one more question, and this is more regarding financials. So if you look at your other expenditure for this year, it's around 134 crores. Last year was around 95.6.
That's right.
It's a 38 crore increase, and I'm trying to basically break it up into where does it come from. I can see advertising and sales promotion, which was around 17, going to around 31. That's where a good chunk has come. But the rest of it, I'm trying to figure where would it fall, because employee cost is not included in this. So where would it really fall? Would it be selling and distribution? Will it be administrative? Would it be one-off something?
So again, on page 8, you can see in the presentation, see what happened is that some of this, what you see is on account of a one-time thing that we did, because last year was our 25th anniversary. So there was a bonus paid to all our employees for the silver jubilee at around 1.7 odd crores. And plus the advertising spends, as you said, went up, and also the sales and promotion spends went up. For manpower that was outsourced, it went up because on account of a larger warehouse, we moved from a warehouse which was 55 odd thousand square feet to 140 odd thousand across multiple levels. And this has been done keeping the future growth in mind. So these expenses have now been incurred already. And once these are done, going forward, these will not increase in the same ratio in which they increased in the last year. And some of it was done also keeping in mind growth ambitions at MBOs, where we have put in staff at our shop and shops, where some places we believe and we are testing how the sales staff can, help enhance the sales further there. So we've gone a little aggressive there, and we are testing these things out.
Sure. What I was trying to basically get to is you had a operating margin of around 33% last year. And that has come down to 28.
Sure.
So there's a 5% impact, or whatever, 4.5, 4.87% impact. How much of that would get reversed in the current year?
See, some of the big things that I made you count, which is there on page 8, already, accounts, there's around 14.9 crores on account of sales and promotion and branding and advertising. There is 9 odd plus crores on account of manpower, and there is another 1.7 crore, which was a one-time payout. That's not going to happen again this year. And then also the other SOR that has been provided for. See, there are marketing investments that we have made in the brand, because the brand is now in a new avatar, and that new avatar has to be taken out to the customers so that whatever perceptions, the newer perceptions that people must form for the brand the way it is, because people who know us, who have seen us, have witnessed us, gave us and propelled our growth that you can see in 21 to 23, right? And that as compared to what it was in 2020 and what happened post that. So that's a conscious investment that's been made in the brand to take the new avatar forward to our consumers. So those investments, and also the new provision, that the higher provision that we have made for SOR as compared to 31st March 2023, if you compare 31st March 24, that is a big number again, which is on account of GR is how many crores?
On account of GR is around 21 crores. Right?
That's the additional 21 crores. Now, if you look at Q1, like I said, it's already factored. The GR provision was already made at 22%, but because last year is at 14.4, so it does not construe to a true apple-to-apple comparison in that sense. So if you factor it in that way, we have managed to, grow the brand, sell extra number of pieces, maintain our gross margins stable in spite of, the headwinds that we have faced in the market. So we're all good. It's just on account of, it's just the period that we are going through, wherein we're going through whatever we are, and therefore we moderated our plans also this year because, like I said, we have always grown our business, calibrating it through the profitability lens, Rahul, and we shall continue to do that.
Absolutely. Thank you so much. So basically, we can assume that we will effectively go back about 30% operating margin next year.
We should be in that range, yes.
Okay. Thank you so much, sir.
Welcome.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question on the line of Anant Mundra from My Temple Capital. Please go ahead.
Hello. Good afternoon, sir. Thank you for the opportunity. So, just wanted to answer, when did we switch to Ind AS accounting?
So we switched to Ind AS accounting from FY'23 onwards. That was the first year, last year.
Okay. All right. And sir, how do we do the deposit accounting? I think we pay out the interest that we receive on deposits to whoever's given us the deposit, basically the franchise owner. Is that correct?
So franchises give us deposits and
As advances towards the goods that we supply to them.
Yeah. And but we don't reduce that from receivables. We park it separately in the balance sheet as a liability and pay interest on that to the franchisees.
So we book we book interest on that, and we also book our interest expense on that. That's correct, right?
Interest expense on that.
Okay. And so what we have one subsidiary. What business does the subsidiary do?
That there is no business being transacted in that subsidiary, and we are looking to.
Yeah. So earlier it was a sampling unit for us. See, because we are a brand, we create samples. So we did not want to send them out for the purpose of secrecy. But now we have taken over the sampling unit from that subsidiary, and we ultimately that subsidiary will get closed ultimately shortly.
Okay.
There are no liabilities over there. Very a clean company with no liability or this thing.
Okay. And sir, how does exactly the COFO model work? Like, who takes the inventory risk in that case? Like, I just wanted to understand how this model works. If you can elaborate on this model, please.
So Rasik will come to the model in a bit, but what we do is we take the risk on our entire inventory. See, as far as I am concerned, the inventory has got my label on it, and that's why my brand has to be managed in a manner in which I do not end up eroding its value. Typically, that happens when, with the kind of production that we do versus the demand that we project. Now, why we prefer to do this is because whatever is left over at the end of season, I want to clean everything up and I want to pick everything back and bring it to myself, because I want to put fresh season merchandise on my counters for my customers every season. And B, whatever I take back, I am able to calibrate my production in a manner in which I am able to sell whatever I have produced so far and whatever is left over also from the profitably. And that's a tight rope we have always walked. Like Rasik said earlier in his speech, that there has never been any material write-offs on account of inventory, and we have always managed to do that, and we shall continue to do that even this year. Whatever is there due to the last couple of seasons where there is excessive inventory, we calibrate it in the next season, and we'll bring down the inventory levels.
Okay. And sir, exactly how does the COFO model work? If you can just elaborate on that.
For the COFO model, basically the lease of the store is taken by us, and the capex in the store, the furnishing is done by us. So we invest in that basically, and we send goods to our franchisee against a deposit, which is typically to cover for the inventory that we send out to them, and the ownership of the goods passes on to them till the time they sell it. And they make weekly payments to us for the goods sold on the counter. And after the season gets over, the goods we call back the goods and we put fresh goods on the counter of the next season.
Got it. Okay.
So we take the entire risk on inventory and we control it. That way, I'm able to manage the entire inventory in my pipeline right from where it is consumer facing to my warehouse, and I have a total control over it.
Got it. That's very good. Thank you for the elaborate answer, sir. And my final question was on that we've done a major revamp exercise in 2019, which has really helped us. So just wanted to understand how frequent does a brand need to conduct this exercise, because the trends keep changing fast. I mean, the world is fast moving now. So how expensive is this exercise? Because you need to revamp all your stores and everything. So just want to understand how often will this exercise be done?
So this doesn't happen every 4-5 years. This is something that happens maybe, every 20 years. Depends on which life cycle of the brand journey the brand is on, and also how evolving a market is.
Okay. So this is like a really long-term exercise.
Yeah, long-term exercise. Of course, a brand doesn't change direction every few years. We did it after we were 20.
Got it. And we had to change all our stores because of this, right?
Of course, we chose to change them because that propelled our sales northward.
Got it. Okay. Thank you, sir. That's it from my end. Thank you.
Welcome.
Thank you. We have the next question on the line of Rajiv Bharati from DAM Capital. Please go ahead.
Yeah, Rahul, sir, thanks for the opportunity. So if you can provide the sales mix in Q4 of FY'23 by channel.
Good afternoon, Rajiv. Just hold on a minute while Rasik pulls out the answer. Can you come again, Rajiv? Sales mix for Q4.
Q4 FY'23 last year for the quarter. I think you have given for the full year, but for the quarter.
So, sales mix, channel-wise?
Yes, sir.
So, channel-wise, see, for Q4, EBO was 57%, MBO was 33%.
Last year.
Last year.
FY'23. Yeah. I'll have to just pull that out, Rajiv.
Yeah, why I'm asking is because you have reported some 3.5% SSG, right? And your store count itself has gone up by 14%. So
Rajiv, I'll explain. That SSG also that you witness is because of, if you remember, I answered that to, I think, Rahul earlier, that last year we had picked up the winter merchandise faster and we had pushed in our summer merchandise earlier in January itself. Okay? So some of that growth can be attributed to that also, because this year the sale went on till later. Last year the sale ended much earlier and fresh merchandise went in earlier. So competition may have been at a discount and we were at fresh. That was something we tried out last year, which I said we've changed to our thing of continuing our sale into February till approximately, depending on store to store, till approximately Valentine's Day.
No, when you're saying this primaries you're doing, that is for the MBO channel, right? Not for the EBO, isn't it?
Primary?
I mean, when you're sending the fresh merchandise for spring summer.
No, it's for MBO and EBO both. That's what we did last year. So what I'm saying is that last year we were on fresh when the market was on discount. And this year, along with the market and competition, we continued our discounts till about Valentine's Day. Hence, that growth also of 3.9% is relative to that.
Okay. So on this EBO bit, if you can specify from when to when did it last this year versus, let's say, last year?
Roughly last year discounts ended at around, what would you say, 26th odd Jan, and this year they ended around 18, 19, 20th of Feb.
And it was there in the Q3 also last year, was it?
What was there in Q3, Rajiv?
Did you start end of season in Q3 last year?
That's what I'm saying. Last Q3 of FY'24, the autumn-winter 22 season at that time went off sale around end Jan. And this year, in FY'24, the autumn-winter 23 went off sale around 19th, 20th of Feb.
So also on this This working capital bit, this 166 odd days, you said that last year it was an experiment which you did. So
Correct.
is it safe to assume that henceforth you will be, doing it, let's say, beginning of the mid of February itself always? So this 166 days number.
Yes. Yeah. It's safe to assume that it will be done around this time.
So the end of your working capital number, this 166, is basically...
No, that will get calibrated. That's not only because of this. That's also because of excessive inventory, Rajiv. I mean, even last year, when we sent goods, faster and got payment faster, but we also got goods back, no? Because they came in sooner. So, don't get confused in that.
So, Rajiv, even the payable days are much lower compared to last year. So it's a combination of all the three, means receivables, inventory, and payables, basically.
No, but just that the biggest lever in this case was the receivable number, right? I think 14 days or something like that was from receivable itself.
Right. So receivables will be similar, maybe around this, but inventory, we will try to control it and bring it a little lower.
Will? Yeah.
And payable days, so means we generally make fast payments to our vendors, so they are lower only.
Yeah, just wanted to, sorry, for modeling purpose, what is the working capital number we should work? Because FY'23 you said is an experiment. So, are you going to settle at 155, 160?
155, 160 should be.
Okay. And lastly, this 52 stores which you opened, what is the mix in terms of franchise?
Very similar.
So around two-thirds are franchise and one-third is company owned.
Sure. That's all from us. Thank you.
Thank you. We have the next question on the line of Sagar Sethi from Sethi Investment. Please go ahead.
Hello.
Yes.
You said that we will double our revenue in 4 or 5 years. Last time during IPO, you said that we will double our revenue in 4 or 5 years.
Yes.
Can you hear us?
Yes, sir.
Sagar, your audio is not very clear. Please go off the speakerphone and speak to the handset directly.
Okay. During IPO, you said that we will double our revenue in 4 or 5 years. Will you achieve it or not?
Of course, we still intend to double the business in the next 4 or 5 years, and that's what we'll endeavor for even going forward. It's not like we're going to slow down our growth or progress in any way. It's just looking at the market conditions. Like I said, we always calibrate the growth of our company profitably. So since this year, if we intend to just quickly chase growth, it may impact profitability. We want to improve our profitability and remain profitable. It doesn't matter. Instead of 4 or 5 years, we may end up doing it in 5.5 years. What we would much rather do is do it profitably. That's how we've always grown the business. So nothing changes from what we said. We intend to do exactly what we have said. It's just that when you're going through a time like this, that's not a period where you just unnecessarily, put a gun to your head to grow, even though it's at the cost of profitability. Because that ends up eroding the value of the brand. The reason why even in such market conditions we are able to maintain gross margins and sustain that is because we've managed the brand. The brand is something which will have to be really, really taken very, very good care of, as though with kids' gloves, so that you can continue running it profitably and growing it profitably.
Okay.
Sagar, would that be the only question?
Yes, sir.
All right. Thank you. We have the next question from the line of Pritesh Vora from Mission Street India. Please go ahead.
Hello, sir. Thank you for the opportunity. I want to understand what is your pre-Ind AS EBITDA?
So the pre-Ind AS EBITDA is around 19% compared to 28% in Ind AS.
Sorry, 19%, 19.
Yeah, 19.
So why can't you, for investor purpose, because we are little bit old-fashioned, why can't you provide us in your presentation pre-Ind AS EBITDA? Many company does that. Retail has a lot of rental component.
Sure, we consider doing it in future.
Sorry?
We consider doing it in future. We keep this in mind.
Yes, sir. And sir, as compared to IPO years, our EBITDA and operating margin has come sharply off after the IPO. So what is the reason, sir, such sharply drop off of EBITDA margin and other things?
Sir, the increase in marketing costs, increase in manpower costs, one-time payout as a bonus to employees on account of the 25th anniversary, and higher provision on account of goods return from 14.4 to 25%. If you do the math after adjusting for these, you'll see that, like I said even earlier, we have managed to grow the business and sell more number of pieces. However, because of the headwinds in the market, there is certain extra discounts that we had to dole out to clear the goods, which is very important.
Understood. So, sir, what is the outlook of going forward? Will you be able to climb back your margins level, or do you think now that this is a new normal?
Certainly, that's what I said, that we intend to grow our profitability and our margins back, and therefore we'll put a gun to our head to do that and not be...
One is the intent and one is the lever in the business to implement that intent. So, what are the levers in the business to implement now this new normal?
Same store growth and working on efficiency of certain costs.
Okay. And how do you count your inventory, sir? What is the inventory phenomenon? I mean, what is the inventory? How many days of inventory you carry, and when you decide to, non-moving item to check off? I mean, what is the policy?
So there's a very, scientific policy we follow to this and have been following since the beginning, and therefore, like I said, we have never had any material write-offs on account of inventory. See, there's a certain facing stock that we need to give to our stores. So we have a system whereby we project what we are going to sell next season, and we produce according to that. And then after a couple of seasons, depending on how the market has gone and how the inventory levels are, given the rate of sale of the inventory at stores as well as at the old season merchandise counters, is where we decide when and how much we should control production for the forthcoming season, because if that goes beyond a certain point and there is too much pressure to discount deeper than what we normally do, then that ends up eroding the value of your brand, which is something we have successfully done and will continue doing so.
Understood. So I'm asking a simple thing. Suppose you come out with a new line of clothes.
Yeah.
And it doesn't sell. So what is the time period beyond which you will say, okay, this line of product or this design, I'm getting rid of it? What is that period?
So we produce for a season and we have 5 drops in every season. And whatever we produce, there is very little such thing that is absolutely that doesn't sell, etc. However, there are various reasons. Sometimes there is a cut size, cut ratio. There are various things that happen, and certain inventory that comes back, we clear it through our system over the next, we may even take 2 to 3 seasons to clear it. But we ensure that we clear it profitably.
Seasons means you are saying 1 year, right? One season is 1 year, right?
One season is 6 to 8 months.
6 to 8 months, and I'm saying 2 to 3 seasons also we take.
3 season means after 1.5 years you will get rid of that.
Yeah. But till the end.
Channels, how do you get rid of it?
I beg your pardon?
What are the channels? How do you get rid of it?
Through factory outlets and e-commerce partners.
Okay. And on the franchisee model also, this inventory remains on the company's book, right?
So for COFO and pure margin stores, for COFO and FOFO model, the inventory passes on to the books of the franchisee till the time we call it back for putting a fresh stock on the stores. Once it comes back to us, it comes in the company's book.
But however, in COCO stores, which are approximately 1/3 in number, it remains on our books.
Yeah. But in COFO, where franchisee operated, there basically you are saying that it will be transferred on their book, and if they are not able to sell back, it comes back to our book, is it?
Absolutely. Yes, yes.
All right. So that's a little bit complicated, sir. How do you keep track of it? Like once you transfer and then transfer back again?
We have a ERP system with us, so we have full control, full track of what's happening at each and every EBO, how much inventory is lying where.
Okay. So you're saying me, sir, after 1.5 months, we will get rid of all the stocks?
After 1.5 months, you mean?
1.5 years, I'm saying 1.5 years.
No, not necessarily. Everything doesn't take 1.5 years to clear. See, we clear it at a rate. We are not in a hurry to deep discount, is what I'm saying. I'm not saying it takes 1.5 years to clear the inventory that we make. You're talking if we have made 100% inventory, there might be 3, 4, 5% of that inventory that may go till the 1.5 year. We are not talking about 50% of it going to the end of it.
And sir, how do we improve our working capital cycle, which looks to be very, very long, sir? It's 160 days above. How do we improve the working capital cycle?
That's what what we do is that whenever we see that the inventory level has gone above a certain level, which is where we control our inventory in the forthcoming season.
So now I'm saying working capital, you are talking about inventory, sir. I'm talking
inventory is what leads to my working capital, sir.
So see, in this basically receivables will be almost around 105 days, and inventory, what Kamasar is saying, we can control that. If there is excess in inventory, we can control it by producing a little less in the subsequent season, basically.
So 105 days of receivable, how do you count that, sir? That looks, if you are selling through retail, you mean to say the pieces remain in the store at 105 days?
Also, so it is not only retail. See, basically we have 4 channels: EBOs, distribution channel, MBOs, then large format stores, and e-com channels also, partners also, basically. So to all these partners, only in EBO 1/3 store we run in our as COCO stores. All the other partners are our customers. So the inventory is sold to them. It passes on to their books, basically.
When I'm talking about receivables, sir, why should there be receivables if you are selling on the retail?
We take the payment. That's the kind of terms of payment that we have with them. The type of margins that we provide to them is basis that we take some advances from them, which lie with us as security deposits on which we pay them some interest. Besides that, from my stores, etc., I receive payments on every Monday of whatever has been sold till every Sunday. And with my other large format stores also similarly, whatever they sell, they pay to me by the 45th day or whatever is liquidated by them. They remove whatever is their margin and pay the monies to me.
Just now you said receivables are 120 days, right? So now you are saying 45 days of receivables.
No. So see,
Mr. Vora, it is from only large format stores.
See, we produce for a season, right? So we have to sell goods to our customers for a season. So the goods will keep selling on their counters for a longer period. Now, there are payment terms with each and every partner. Like for my distributors, the payment terms are 60 to 70 days.
I'll take you offline, sir. This question I'll take you offline, sir. Thank you.
That will be better. It will be easier for us to explain to you. Thank you so much.
Thank you.
Thank you. We have the next question on the line of Yash from Exponential Research. Please go ahead.
Yeah, hello.
Hi.
Yeah, sir, my question is around CapEx. So basically this year we added about 36 of COCO plus COCO stores, and the average CapEx per EBO is around 28 lakhs. So the figure comes to 10 crores. And last year also we added about 42 such stores, and so 10 to 12 crores of capex. If we consider the average capex per EBO, but capex for both of these years is around 35 crores each. So if you can just reconcile the figure, like if it's a store, in-store capex that we incur, or we have revamped the EBOs, because of which we have incurred additional capex. So, sir, any light on that would be helpful.
So it is both the CapEx for new stores as well as renovation of the old stores. That keeps on happening every year. Some stores keep on get renovating every year.
Okay, sir. So that will be like recurring CapEx, that will be there. Like, so if I have to assume a maintenance CapEx, it would be around 30, around that, like 20 to 25 crores.
Yes. And that we are able to do from internal accruals. So that's not any problem for us.
Sure, sir. Got it. Thank you.
More or less, the renovation of stores is more or less done, because now almost, I would say 75-80% of our stores are either of the new identity or of an identity which was just prior to this generation, but they have been moderately modified to match this generation. So as and when they come up and they become due for renovation, and according to the time, etc., we go on renovating them.
Understood, sir. Thank you.
Welcome.
Thank you. We have the next question from the line of Rajiv Bharati from DAM Capital. Please go ahead.
Yeah, thanks for the follow-up, sir. So just one thing on, you mentioned that April was okay, May demand dwindled a little. Say the trend continues, something like that. Will you be able to, let's say, control your inwards for the upcoming season, or that order is already placed and that course correction cannot be done?
Good question. We've already controlled those levers. And hence we said that by end of the year, we should be able to bring down our inventory levels.
Sure. And on the warehousing bit, what are the CapEx this time around, purely on the warehousing bit?
So this year, we have not done CapEx in warehousing. It was last year, basically.
So the entire CapEx is towards the maintenance and the new stores addition?
So CapEx for my warehouse would be around 13 to 14 crores.
This year?
No, last year.
Last year.
So the previous participant's question, 35 crores, that can be entirely attributed to the stores. There's nothing on the warehousing.
So that, Rajiv, I'll have to look at the numbers, but it would be mostly a function of the ROU, right of use, basically,
No, the CapEx number is the cash flow number, right? That will be clean number, no?
Have a look. I'll get back to you, Rajiv, on that. If that's okay?
Yeah, that's fine. Thanks a lot.
Thank you.
Thank you. Due to time constraints, that was the last question. I would now like to hand it over to the management for closing comments.
Thank you, everyone, for joining us. I hope we've been able to answer all your queries. We look forward to such interactions in the future also. In case you require any further details, you may contact Mr. Deven Dhruva from SGA, our investor relations partner. Thank you, and have a nice evening, everyone.
Thank you. On behalf of Credo Brands Marketing Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.